Hi everybody, this is Efrem Hoffman from Naked Swan Trading, and today what I'm going to be speaking about are critical risk windows and a new technology for actually identifying the precise timing of when major volatility events are likely to occur in the financial markets. The actual heart of the technique actually speaks directly to what George Soros has talked about for a number of years, and that is the concept of reflexivity. What that basically means is that market participants' views of the future cannot correspond to the actual reality. That's partly because the reality is not something that is independently given. It's something that is contingent on all of the participants' views of the future and their perceptions. But the problem is that our perceptions are often distorted by the way we actually look at information based on the basic paradigm of how we have been taught to look at data sets. And that paradigm has basically been comprised of looking back in the past for patterns and then seeing where those patterns revisit themselves at future points. And we all know that over time you could backtest the system all you want, and you will find inevitably in the future those patterns will not replicate. They may seem to rhyme for a time, but then there'll be some kind of major event that derails that strategy. And one thing about trading is that you need to have the confidence in acting in situations where there's a great amount of uncertainty, and then knowing not to stop using the trading system that has a great edge just because one or two trades or a sequence of trades don't work out. Even worse is not knowing whether the trading methodology you have in the first place is one that actually has a trading edge. And what I'm going to show you today is a better way of analyzing market information. And that way does not rely on looking back at patterns in the past. It actually looks at trying to reverse engineer what other traders are going to be seeing across different time frames based on market momentum indicators. Now, we all know that the MACD indicator is useful at critical turning points when there's a crossing in the indicator, but at the same time it tells you nothing about the magnitude of the forthcoming move, the price levels in the future where zero momentum points are going to cross. And it also, based on looking at those patterns, it doesn't tell you how persistent trends are going to be in the future with any great degree of reliability. Okay, so what I have done is created a market map, which you could see on the screen right now. And basically, what this market map does is it provides information about where in the future participants are actually going to be seeing zero momentum crossing points. So for example, every one of these boundary conditions or lines that you see into the future represents a different time horizon. So for example, right now we're looking at an E-mini chart on a daily time frame, okay, of the S&P 500 September contract, and the current price bars that you see in the screen are candlesticks. They represent the range of the bar from high to low on the day. And basically, every one of these lines that you see represent the exact same thing, except it's from a time frame higher than a daily chart. And anything smaller than this red line, like this blue line, represents something from a shorter time frame. And by analyzing and overlaying all the zero momentum balance points on the screen at the same time, it gives me an idea when there could be a domino effect in the market. Like think about dominoes, for example. In any domino competition, if you're trying to determine what the maximum toppling rate is going to be, the best way to win the competition is to theoretically space the dominoes in such a way that the distance between each domino is about 40% of the height of the domino. Well, it's similar in the financial markets. The numbers are different, and the dominoes are of varying heights because there's different traders on different time frames that are actually acting at different points. But the same concept is there. That is there a way to actually see a map of where people are positioned and in terms of what they're going to be perceiving in the future in terms of zero momentum, such that you could tell how the market dominoes are going to be moving on one side of the market or the other. Okay? So for example, let's just pick this yellow line over here. This yellow line happens to represent a certain time frame, and if price was to land on that line at any point in the future, that would represent a 0 point on the MACD indicator. On a higher time frame, on a progressively higher time frame, anything on this line over here would represent zero momentum. So now we have a way of calibrating zero momentum points with specific price levels in the future. So this way, if we have a confluence of boundaries that happen to be converging around a certain area in price and time, and then price gets on the other side of the boundary, that could tell us a lot about where the market is moving. The distance between the boundaries tell us something about the magnitude of the next potential movement. And the shape of the boundary, whether it's sloped up or down, tells us something about how people's perceptions of momentum are going to be bending or changing in the future. For example, it's a little counterintuitive. In a normal kind of moving average, you would expect that the more upward sloping the line, the stronger the trend. But we all know from experience, the more a trend becomes obvious, the more trouble it could give a trader when it decides to turn course, because there's a crowding of positions in at levels as a market makes a top or a bottom, and then when the market turns the other way based on uncertain events, there could be a mass unwinding. We want to be able to identify those critical risk windows in time and price, okay, such that we could have an idea when this type of toxic order flow could impact our pocketbook, okay? And what I mean by toxic order flow is that often what happens in a market, in a volatility event that's about to roil the markets, you'll get a lot of informed traders, in-the-know traders that put orders in, and then the market makers try to take the other side of the trade. But if the informed traders are just starting to put those trades in, knowing that there's going to be many more to follow, what happens is the market maker ends up getting really hurt in the process, taking the other side of the trade. And what ends up happening at extreme turns is that the market makers start withdrawing from the market, and liquidity leaves the market, and it opens up a large gap which yields higher volatility. We want to be able to see those gaps, but using normal moving averages, especially when you're very far above the 200-day moving average, or if you're in a parabolic move, or if you're in a move that doesn't have news events attached to it and it seems to be going up on air, or a no volume, then you really need a method that tells you something about how the underlying perceptions of the crowd are going to change in the future. So at Naked Swan Trading back in May, we indicated that there was a critical risk window that was developing, and we actually saw that way back over here, okay? And the window, basically, we discussed, was going to create a large-scale volatility event to begin in the beginning of May and continue, at least in the first step, into the July period. So we're still in the corrective phase. So I'm going to zoom in here on this daily chart of the S&P 500 September futures contract and show you what I see, okay? And I'm first going to discuss what I see in the context of what other traders see, and then make sense out of that information based on what this perception map is telling me. So basically, on March the 27th, the market rallied up, made a high with about 1.2 million contracts. The day prior to the high, which was the upthrust day, went up with about 1.4 million contracts. Okay. Then the market sold off, came down on April the 10th with about 2.5 million contracts, rallied up towards the high again without making a new high with 1.3 million contracts. Okay, so there was a little bit. The number of contracts on the rally up was less than the number of contracts on the upthrust before the high. So that was showing that volume was selling off, was fading. And then the market started coming down. And you could see that on the day of May the 4th, we came down on heavier volume of over 2 million contracts, going into the low bar of April the 23rd, which was 2.8 million contracts. Okay? And then the market reversed. We didn't have enough volume to come down. But then on the next reaction down, the market came down with 2.8 million contracts compared to the low of, over here, which was around 2.8. So we had the volume, and then we accelerated in the volume to 2.9 million contracts. To 2.9 million. Then we had a retracement with an upthrust of about 2.2. So we came up on lighter volume, which is normal. Okay, and then we came down again with about 3 million. So we came down. So this is a normal kind of structure that Elliott wave traders would look at. I'm very familiar with Elliott wave. I don't use it because it has a number of pitfalls, but it's still helpful to discuss it in the context and then show what we are actually able to identify in terms of magnitude. So because over here it came down with volume, you would expect that you could get a reaction back up, but it's likely going to revisit the lows because usually a market won't make a low until it comes down on lighter volume and reacts into the original bar that broke down. And you could see this bar that broke down, like that low on April the 23rd, broke down with volume for the first time over here. So basically the high of the low bar of the break point would act as resistance. So that would be about 56.75, to the original bar of about 63.75, and that's exactly what happened in the Monday market call that was put out at Naked Swan Trading, and I encourage all of you to sign up at the top of nakedswantrading.com. Just put in your name and email, and you will get those free market updates each week delivered to you on Mondays mornings that will actually give you a heads up of what's going to happen in the S&P. And what we said this week is that that this area was going to act as resistance in that 56.50 to 63.75 area, and the market rallied as high as 57 and then gave it all up. Okay, we also had a zoom in map on a 30-minute basis that actually showed that 55.50 was going to be a critical point, and we kind of retested 55.50 on the 20th and then gave it up again. And you could see when it came up over here, it came up on very light volume. Okay, 1.7 million compared to the down volume of 3. So this market is starting to come down again. It's with 2.6 million. So if the market would have hit the lows today with yesterday with 2.6 on some kind of major sell-off, then there would have been a major reaction back up. But that's not the case. So we could still accelerate on the way down. Okay. Now in the context, outside of just knowing these volume points that are relevant, that's not going to really tell you anything about if there's going to be a much more dramatic event than we've already seen in the future. Like, is it just going to do a wave 5 down and touch the lows, and then that's the end of it, and then go back to the highs and we're back in a bull market? Or is the market actually setting up a structure or an arrangement in such a way, a domino arrangement in such a way, such that the way people will be perceiving changes in momentum in the future is going to cause them to actually change their sentiment from being somewhat neutral to very, very bearish? And what I'm seeing right now is a confluence of events developing that could lead to a stock market crash. And I mean a stock market crash on par with something that we've seen in 1987, on par with what we've seen in 2008, and possibly worse. Now, the way the market is, the different ways the market is going to arrange itself in the preparation for that crash is certainly, there's a number of scenarios that could play out. And I'm going to discuss those scenarios here with you right now. Now, so far I talked about, what was discussed in our previous market calls. But for a lot of you that are new to this, who haven't heard our previous market calls, I'd like to now talk about what we see upcoming and what the relevant points are in the event that positive and negative news flow come into the market. So right now, we're sitting here at 1323.75 in the S&P. Now, in the context of this market map, anytime we see a situation where we have a confluence of upper boundaries, okay, and you could see over here, and you don't have to, you don't have to worry about the details here. We're going to be providing instruction on this in the future. We also have a Traders World article that was written about the technology that lays it all out. You could go to the website and you'll see it on the left-hand side of the screen under the crash alert. Also, just to let you know that on the screen you may actually see that it says the next webinar is going to take place in 364 days. That is obviously a typo. It's happening right now, and it happens on a weekly basis in terms of our market updates. Okay. Also, I'm going to zoom in over here, and you can see right now we have a number of upper boundaries that are sloped up. And like I said before, unlike a moving average that tends to tell you that things are getting better when they're sloped up, it's actually the opposite with these perception boundaries. Because if these boundaries, which they do, represent zero momentum crossing points, it means that if price was to cross below a boundary, it means momentum would be perceived as negative for this specific time frame. Okay? Now, for this time frame, and no one time frame is more important than another, you have to understand how the time frames interrelate, and that's what I've studied for the past 16 years and have built up from a number of patents that I have actually got back in the early 2000s on analyzing large-scale data sets. Okay? And what I've studied is I've studied the dynamics of extreme behavior in the market and what that extreme behavior could tell us about the everyday events that we see as traders in the market. Okay? Now, for example, on this boundary, if this represents zero, then if we cross below this boundary, this teal boundary over here, then the perception for these traders would be negative. Okay? But what does that tell you about the future? Because these boundaries project out to the future, and for part of the way they slope up and part of the way they slope down. Well, if this represents zero, if I was to put a horizontal line at the current price level, assuming no new information was coming into the market and prices just stayed stationary, how would people's perceptions of the current market bend in the future? Well, if this line, as I said, is calibrated to zero momentum and price stays the same, it means that price is going to become further and further below the zero line, which means that the traders on this time scale in the future are going to be perceiving their MACD or momentum indicators as more and more red below the zero line. So their perceptions of momentum are going to become more bearish. So the very shape of this boundary being up into the July 26th area tells us something about the fact that there is a tremendous headwind in the market going into that period. On top of that, we have a confluence of boundaries, this yellow boundary, this blue boundary, this black boundary, that are all sloped up. And these are, as I said, boundaries that project further into the future, represent longer-term traders. And we all know longer-term traders put more commitments on when they trade. So it tends to have more relevance if you're going into resistance that is of a longer-term nature. And that's exactly what happened here. When the market was rallying into that volume bar between the 56.50 and the 63.75, the market was also going into a confluence of interference between this yellow boundary of 1340 up to the extreme area of 1375.50. And you could see over here that this confluence flatlines all the way into the September period, which basically means that we have very, very intense resistance holding the market down. So for all those people that are trying to be as optimistic as they can about what the policymakers are doing, I could just let you know that from the perspective of this map, which has been extremely reliable in identifying all of the major crises in American history and international history, and I've studied this going back several hundred years, and there hasn't been a situation where a crash has occurred when we didn't have a risk window. Okay? That doesn't mean that every time you have a risk window you have to have a crash. But what it means is that the upside potential is very, very limited, and the downside potential is very, very great. So what does that mean? Well, what it means is for an investor that happens to be long the market, they should be seriously thinking about pairing off their positions, or at least hedging themselves in some kind of way during that window. Now, it's nice to know that those windows have a limited amount of time, or where those windows are, because a lot of people that don't know, when a tail risk event or an extreme event could happen, they tend to always hedge in the market, and that's a drag on their performance. It would be nice if somebody could just, have their normal long positions on and then know when it's time to actually implement a hedging strategy, either in the form of buying protective puts, or in the form of actually, staying out of the market during that period, or better yet, participating on the short side, either in securities, or buying ETFs that have enough volume in them that are inversely related to the market, so you could participate in downside action. Now, the nice thing about the market is that the down moves occur very, very quickly. So it doesn't take very long before it comes down to a key support point, and you could actually then participate in the market. So I only have a few minutes left to discuss this, so I just want to leave you with a few details. And in the coming weeks, you could sign up at our website for these. You could sign up today for the free weekly webinars, but also we're going to have a number of products being released and rolled out that could give you access to this on a daily basis as well. So what I see over here unfolding is going into that July period, that you've got risk down into this 1256 area. If you get underneath the 1243 area, then this red line is going to act as resistance going right into the end of the year. Okay? And it starts out at 1289. And it goes up to the top here at 1275. But the downside risk is to have a move that's taking you down to 1115 on the S&P, 11 or 1140 at the upper end. So we're talking a 200-point sell-off from this upper zone, which is an enormous move. Now, the real danger in the market is that when we get into the after the December 7th period, and specifically up to the January 11th period of next year, getting underneath the 1070 area, which I do believe we are going to be doing next year, that's going to open up a move down back to the 700 to 800 area in the S&P. And I don't believe that will be the end of the crisis. I do believe that, yes, you will likely get huge bounces back to 1200 again as a possibility. But I do believe that this is a long bear market, that what it's showing right now, and I'm going to just take us quickly to a weekly chart before I close out this webinar. And basically, what my main concern is that once we do get down to the 700 in 30 area, you get those big bounces back. Everyone's going to be bullish again, but again, all these boundaries are upward sloping, so there's going to be a tremendous amount of resistance in the 1170 to 1200 after that time. My concern is when we, in 2014, and I know that's a long time away from now, but in the past I've looked out much further than these kind of time periods, and events do happen. So if we get underneath those lows of 667, which I do believe we will in the 2014 to 2015 period, then we're talking about the S&P heading down into the 400 area or lower. And that would result in the deleveraging process ending and a new bull market beginning. But until such time, I just do not see how people could actually be bullish. And you could see here how we have a tight confluence of events converging into the end of the year, so that it really doesn't matter. All this is just short-term action. Like even going down to this area of 1128 on the S&P. Okay, that will be support because this is a downward sloping line. Then you get a bounce, but the bounces are limited. That will form an ABC, another ABC down structure that is going to fail with volume at the highs, and then you're going to have a major break to the downside. So huge opportunities for short traders to participate in this action, both in the long term and in the short term, if you follow our weekly updates. So also we are available on Twitter also for giving updates at Naked Swan Trader. So that is the update for today, and I thank you all for listening.